Let's dig into those earnings results that are out later this week as investors gear up for the busiest week of this earnings season. Joining us now, we want to bring in Dan Flax. He's Neuberger Berman's senior research analyst. Dan, it's great to have you. And let's zero in on the tech sector because I know that is what you are closely watching. When you take a look at these Mag 7 members that are set to report this week, how much is riding on these results?
Good morning. Good to see you. I think it's going to be important in terms of getting an update on some of the cyclical factors. There's clearly patches of weakness in the consumer. I think the enterprise is slower. But if we step back and think what's happening, you have this build out of the digital platform, the cloud, artificial intelligence. These secular trends remain healthy in my view. So I think what we'll see, for example, with Microsoft, their Azure business, I think you'll see good growth there. I think with Amazon Web Services, you'll also see healthy growth there. And I'll also highlight the Google Cloud business, which we think is an underappreciated opportunity for them. And so I think that will remain healthy. We'll see how Apple, what they say in terms of the very, very early days with the new cycle. Apple Intelligence, of course, is rolling out, and we'll see a lot more there in the weeks and months ahead. So we see select opportunities, being, of course, mindful of some of the cyclical dynamics.
You know, the earnings bellwether coming into this season had been Nvidia for several quarters at this juncture. But is it possible we see one of the companies this week, from your purview, actually take over that bellwether status and really set the tone, especially going into and amidst the fourth quarter as we get a little bit more of the outlook about the consumer and even the setup for 2025?
I think Nvidia is going to remain important in terms of its partnership with a lot of the cloud vendors like Microsoft, like Amazon, like Google. They're an important partner for Meta, of course, as well. I do think if we look at Amazon later this week, we'll get a read into the health of the consumer where there is some softness. I think the cloud business, which is a critical driver of the company and the stock, I think remains healthy. I also think they have an underappreciated opportunity in advertising. But to dig in a little bit on Amazon, what they're trying to do, even in this more difficult period, and we'll see what they say about Q4, is really drive more value in Prime, as an example. So more one-day and same-day delivery, more video offerings. And so the key in this period is that you need a company to be able to invest, set itself up for growth, while at the same time, of course, navigate some of the challenges that all the companies are facing, given weakness in parts of the economy, both here and overseas.
Dan, what about the risk of hyperscalers pulling back on AI spending? How real is that risk, and when do you think we'll likely see it?
The hyperscalers are investing aggressively because they have tremendous revenue opportunities. You see it in their backlog. The spend is inherently lumpy, and so we're in a period of very, very strong growth now. And so some of the growth rates, I suspect, will moderate over the next year, although the absolute dollars being invested, I think, will continue to grow. These companies are trying to take and have been able to take a multi-year outlook in terms of investing to drive growth in key areas like the cloud for new workloads, such as artificial intelligence, while at the same time knowing they have to navigate all the cross currents in a given quarter, manage their costs, try to deal with unforeseen events, which of course occur very regularly.
Dan, are you seeing any signs of AI exhaustion?
I don't think it's exhaustion. When we speak to customers in the enterprise, a lot of them are very excited and interested, and they are investing in artificial intelligence. And what they're trying to do is to isolate specific workloads where they can get value. So, for example, software coding or contact center or automating more of their processes. And so it's a step-by-step for each organization. The cloud companies are able to scale it and see a return on these investments in a reasonable time frame. So they, in contrast to the enterprise, should continue to invest aggressively, in my view.
You know, anybody who was firing up the NASDAQ composite or even the NASDAQ 100 this morning and thinking about the number of components within that composite that are going to be reporting over the course of this week, they're going to be looking at how close these companies are in aggregates to all-time highs. Have valuations run too far? And what are you going to need to hear from companies to say and suggest that they're able to grow into those valuations and scale into them at a healthy rate?
What we look for is really companies that have distinct intellectual property, that they're able to execute on their product cycles and really do that again and again as technology markets transition. So they need to generate durable revenue growth, and they need to translate that into strong free cash flow, which they can in turn invest back into their business or return some to shareholders. When I think about valuation and I think about the free cash flow generation of some of the companies, Microsoft is an example, Apple is another example, I think valuations are reasonable. What we're focused on is really how the second half of this decade is going to shape up. And so clearly 2025 is very important, but we're trying to think through and position for 2026 and beyond to really capture some of the significant growth opportunities that we see, while of course being mindful of some of the near-term cyclical challenges that all companies are facing.
Dan Flax, who is the Neuberger Berman Senior Research Analyst. Dan, thanks so much for taking the time here ahead of the opening bell this morning. Appreciate it.
Thank you.